If you still keep most of your cash in a high-yield savings account, there's a very good chance your bank is quietly winning at your expense. Most people hear 4% APY and immediately think, wow, my money is finally working for me. But here's the problem. Your bank may be making 2, 3, even 4 times more using your money than they're paying you. And the craziest part, millions of Americans still believe a savings account is the smartest place to park cash, while smart money has quietly been moving somewhere else. Money market funds, not crypto, not risky stocks, not some TikTok finance scam. Just a different place for cash. A place that, in many cases, has been quietly paying more than high-yield savings accounts, while banks desperately try to keep your money sitting still. And by the end of this video, you will understand why money market funds are exploding in popularity, why banks hate this shift, and why what feels financially responsible may actually be quietly costing you thousands. Savings accounts feel safe. That's why people love them. Your parents use them. Your bank recommends them. Finance influencers call them smart. You open your banking app, see your balance sitting there, and feel responsible. But safe and efficient are not the same thing. Meet Jake and Marcus. Both have $80,000 in cash. Jake keeps his money in a high-yield savings account, earning 4.1%. Marcus moves his money into a money market fund, earning over 5%. At first, the difference feels tiny. That's the trap. Because wealth is rarely destroyed dramatically. It disappears slowly through small percentages most people ignore. And banks know this. The moment people hear high-yield savings account, they stop comparing. And when customers stop comparing, banks win. Now, before people hear the word fund and panic, a money market fund is not some risky Wall Street casino. Most government money market funds hold short-term treasury bills, government debt, and ultra-short-term institutional assets. Here's the easiest way to think about it. A savings account is where regular people park cash. A money market fund is where institutions often park cash. That difference matters because banks use your deposits to make money. They take your cash, pay you 4%, then lend that same money out at much higher rates. Mortgages, credit cards, loans. That spread is how banks make billions. And once rates started rising, people noticed something uncomfortable. Money market funds were often paying more than savings accounts. That's why billions of dollars quietly started leaving banks. Your savings account may feel like a favor from the bank. It's not. It's part of their business model. You deposit money. The bank uses it to issue loans and generate profits far beyond what they pay you. Your 4% savings rate sounds amazing until the same bank charges someone else 24% interest on a credit card. Your money works extremely hard, just not for you. And the reason banks love savings accounts is simple. Most customers stop asking questions. They choose familiarity over optimization, and comfort is incredibly profitable for banks. Now, before you move all your cash tomorrow morning, there's something important to understand. Savings accounts are typically FDIC insured. Money market funds are investment products. That matters. But many government money market funds are built around extremely short-term government assets designed for stability and liquidity. That's why institutions and wealthy investors use them to park cash temporarily, not because they're gambling, because they're optimizing idle money. Meanwhile, most people leave cash wherever it feels convenient. That's not strategy. That's autopilot, and banks love customers on autopilot. Let's run simple numbers. Jake keeps $100,000 in a savings account, earning 4.1%. Marcus puts $100,000 into a money market fund, earning 5.2%. Year 1, Jake earns about $4,100. Marcus earns about $5,200. Most people hear that difference and think, not a big deal. But wealth changes through small percentages repeated for years. Over time, tiny gaps become thousands of dollars. And this is what financial institutions understand better than average consumers. Small spreads become enormous profits at scale. That's how banks think. Scale. Average people think about comfort. Wealthy people think about efficiency. This video is not really about money market funds. It's about financial behavior. Most people do not optimize money. They optimize comfort. They stay with the same bank because changing feels annoying. They leave large amounts of cash sitting idle because researching alternatives feels overwhelming. But wealth does not reward convenience. It rewards efficient systems repeated consistently over time. And convenience has become one of the most expensive habits in modern finance. Most people will spend hours researching a new phone, but won't spend one afternoon learning where their money should actually sit. That's why average people stay financially stuck, not because they never earn money, because they never optimize it. But here's the funny part. Savings accounts are not even the biggest cash trap most people fall into. Not even close. Because once people realize their savings account may not be the best place for cash, they often run straight into something else that feels safe. CDs, certificates of deposit, locked rates, guaranteed returns, no volatility. Sounds perfect until you understand what happens when your money gets trapped at the wrong time. Because millions of people are locking cash away for years, chasing safety, while inflation, taxes, and opportunity costs quietly eat them alive. And the worst part? Most of them feel financially smart while it's happening. So, in the next video, we're going to break down why CDs became so popular, why banks love when people lock up money, and how guaranteed returns can quietly become guaranteed regret. Because in personal finance, what feels safe and what builds wealth are often two very different things. Banks are not evil. Money market funds are not magic, and savings accounts are not useless. But financial systems reward people who understand how cash actually moves, not people who blindly follow whatever product feels familiar. Your money is always working for someone. The only question is, who is it working hardest for? You or the bank? If this video changed the way you think about cash, hit subscribe and comment below HSA if you still prefer savings accounts, or MMF if you think money market funds are the smarter move. Because the people who build wealth long-term are usually the people willing to question things everyone else accepts automatically. And most people never even start asking the questions.